Hey everybody, Smart Silver Stacker here. Welcome to another live stream. So we need to talk about the price of silver today because silver is actually on the verge of a major breakout, but we're seeing a little bit of a pullback today. The price of silver is in the red along with markets across the board. In fact, just about everything is down today except for crude oil. We're going to talk about that in just a moment, but let's talk about what is driving this pullback in the price of silver today. Because if you've been watching this channel for any amount of time, it should come as no surprise to you. It was once again hotter than expected inflation data. Yeah, we got the PPI data, a wholesale inflation measure. Today, we got information that it was just up 0.6% in February. That is double what was expected. Now, imagine my shock, imagine your shock at the fact that inflation continues to show signs of not abating the way that we have been told it should be going, right? I mean, the narrative from the political elites, from the central bankers, has consistently been for the past several months inflation is done. It's going down. We've got disinflation. That term was going around for a while. And yet now, data after data is confirming that inflation has not run its course, that it is here to stay, and that the Federal Reserve has not gotten nearly aggressive enough with its campaign of rate hikes. Now, the problem here is that investors, markets, whatever you want to call it. I mean, honestly, a lot of the trading that we're seeing, on these hotter than expected inflation numbers, every time they come out, you see gold and silver sell off. A lot of it is probably automated at this point. It's algorithmic trading. It gets a headline. Gomer says it's the PP lie instead of the PPI, and that's right. Now, this PPI, let's talk about this. This is wholesale prices. This is a measure of raw, intermediate, and finished goods. It's supposed to be a leading indicator of price inflation because it shows jumps in prices early in the supply chain. So when you see this going up, that means that you can expect prices for things you are actually paying for to move up into the future. So, inflation again, once again, showing no sign of going anywhere. The anticipation was that we were going to get a 0.3% increase, hitting 0.6, and silver and gold selling off. But, I mentioned gold, or rather silver is on the verge of a major breakout here. Now, we've looked at the chart of gold quite a bit because gold has broken out of a major cup and handle formation on its long-term chart. Now, I want to take a look at the chart of silver here and show that it has not broken out of the pattern yet. However, it is approaching that top trend line there, the top of the handle. And, gold has already broken out of its trend line, the top part of this trend line, blown through it, in fact, to new all-time highs. And silver is looking like it is about to do the same. Now, that was a weekly chart we were just looking at. Silver actually still up on the week. And interestingly enough, it was just on Tuesday that we got the hotter than expected CPI data for February. Now, what happened on Tuesday? Gold and silver sold off, right? They pulled back. I mentioned on the live stream there that was an opportunity to get into these markets. Now, of course, it's not financial advice. I'm not telling you what to do. But I do view these pullbacks as opportunities to buy into the precious metals because what happened on Wednesday? I mean, the markets took about a day to digest that hotter than expected CPI data. And then the precious metals had a solid bull run yesterday. I mean, we're hanging on to most of the gains. Silver's still above 25 bucks at the moment. So, the fact that the impact of these hotter than expected inflation data reports seems to be declining as we move forward and we continue to receive them. And the gold and silver markets seem to be more and more resilient. I would not be surprised if, barring any outside news, we see a pretty solid day for the metals tomorrow, just like we saw yesterday. The whole thing here is that markets believe, or algorithms believe, whatever you want to call it, that higher than expected inflation data is indicative of the Federal Reserve being tighter in their forward policy. But, I think that that is anything but the truth. Again, if you want to get some gold and silver now, before the markets break out, before silver crosses that upward trend line, make sure you check out today's video sponsor, SD Bullion. This is sdbullion.com/new. This URL I'm looking at right here. If you're a new customer, you can actually get some gold or silver at spot price. So make sure you check them out, especially if you are new to stacking. That is where I buy my gold and silver. Now let's talk about why the Federal Reserve, regardless of where this inflation data goes, is going to be cutting rates very soon. It's an election year. Keep that in mind. Markets are on the verge of some significant crises here moving forward. How about this? This was last week. Powell told us in congressional testimony that there will be bank failures caused by commercial real estate losses. So that's one significant reason that the Federal Reserve is going to have to get out there and cut rates regardless of how high inflation goes. And this is the quote from him. He says, "This is a problem we'll be working on for years, I'm sure. There will be bank failures." And he's referring to the crisis with collapsing commercial real estate prices, a crisis which has been brought on by the Federal Reserve's campaign of higher rates, hiking up mortgage rates for buyers of commercial properties, driving down demand for these properties. Currently, many of these bank balance sheets, there's several troubled banks. NYCB is one. There's others, though, that have a lot of exposure, small banks, to this commercial real estate sector. And, if they're not lucky enough to be considered one of these banks that's too big to fail, they're not going to get a lifeline, a bailout. We could see more bank failures. He kind of seems to blow this off, saying, now he mentions here that it's not a first order issue for any of the very large banks. I think Wells Fargo actually, and this is not the quote, this is just my commentary, has the biggest exposure to commercial real estate out of all the major banks. But then he goes on to say, it's more smaller and medium-sized banks that have these issues. We're working with them. We're getting through it. I think it's manageable is the word I would use. Now, you have to remember that it's the Fed's job to instill confidence here, right? It's all a con game. It's all a confidence game. And as soon as confidence is lost, you can see these cascading financial crises like what we witnessed last March, when, by the way, the demand for gold and silver spiked up dramatically, especially the physical kind. We saw premiums surging, we saw delayed shipping times. So that's why I think now is a good time to get your hands on some physical metal before another event such as that occurs. But that when these banks start to fail, one, it can trigger a cascading crisis. There's so much leverage in the system. And now the whole banking system is generally insolvent. They're sitting on these huge losses from unrealized losses from devalued, low-yielding U.S. Treasuries that are on their balance sheet. That is why the Fed had that bank term funding program, which just ended, by the way. But I expect that they will be extending those loans. I expect that they will be implementing another facility like that, unless they get out there and begin cutting rates. And again, this is why the amount of money creation is basically guaranteed. There's no way that the Fed, they've created this huge bubble, this system that is entirely dependent on easy money, and they're not going to cut off the lifeline to these institutions. You saw just last March how quickly the Fed and the Treasury and the FDIC and everybody were to move to ensure that the banks were capitalized. They arranged these deals, to bail them out. Of course, that was all just kicking the can down the road. None of the problems were solved, as evidenced by the collapse or the massive share decline of NYCB. They were one of the banks who acquired some of those troubled assets. Turned out they weren't so strong. At the time, regulators were saying, oh, NYCB, the New York Community Bank Corp, they can handle these troubled assets. Well, apparently not, because they're revealing now that they have billions in losses. That's why their share price has been more than cut in half over the past couple of weeks. But that's one reason. The Fed even acknowledges that these banks are going to be collapsing. It's not a secret. We're in the midst still of a major banking crisis. And, people talk a lot about the number of banks that collapse because historically, yes, banks collapse every year. It's true. But when you look at the deposits of the banks that are troubled, last year, the 5 banks that failed, actually their combined deposits was greater than all of the banks that failed during the great financial crisis. So not all bank failures are created equal. And this time around, they're either going to need to cut rates dramatically, they're going to need to get into the Treasury market, renew QE, drive interest rates down, get that commercial mortgage interest rate down so that buyers can come into the market and prop up the value of these properties. Because right now, many of the banks, if you were to market the assets on their balance sheet, they would be insolvent, right? The banks, the collateral for these loans is not worth the amount of the loans. So who's going to take that loss? Well, it either means that the Fed's going to cut rates and drive the value of those properties back up, or they're going to be bailing the banks out. Either way, they're going to be running the printing press quite a bit. So, that's one reason. I mean, there's a number of factors right now that could force the Fed's hand into printing more money and slashing rates. How about this? I mean, you get the TikTok ban, right? They just passed this bill. Biden's telling us he's going to sign it, this bill to ban TikTok. Now, never mind that bill is likely to be used to suppress domestic speech. Just watch that, and it's probably going to pass. It's got bipartisan support. Both parties like restricting Americans' liberties and controlling media. I mean, the whole idea is that we're getting brainwashed by TikTok, I guess, and TikTok spying on us. But in America, you're only allowed to have domestic companies like Facebook and Google spying on you. No TikTok, no Chinese spying allowed. This is antagonistic to China. Maybe they'll dump their U.S. treasuries. I mean, that's another example of an item that could force the Fed to get into the market and begin buying up U.S. treasuries again via quantitative easing, right? If some power around the world that holds a significant amount of U.S. debt starts to dump it, the interest rate starts to spike, well, someone's going to have to buy up that debt, right? Who's it going to be? Well, we know it'll likely be the buyer and lender of last resort. It could be any number of things, right? I mean, black swan events are on the horizon. Of course, by their very nature, we don't know exactly what those will be, but you do the math. We've got an open border. It's an election year. The FBI director has told us that the risk of attacks is greater than pre 9/11. There's a lot of things going on right now, right? And I don't think the algorithmic traders, investors in general, really are factoring in the need for safe haven assets. Of course, when we look at the spot price of silver dropping, it's not even really physical metal. The real safe haven asset is just a paper derivative. So you got to keep that in mind too. But it does serve as a proxy, and it's really the thing driving the price for the physical metals. And I think that's a huge opportunity for us because there's going to come a time, I think, when people really want to get into the real thing, not paper. And you might see, and I've mentioned this many times on the channel going years back, but I think that we're closer to it than ever before, an event where you see a complete divergence of paper silver from the real physical underlying metal, meaning that you might see the spot price at $25 and yet an ounce of silver might cost you 50, right? Because a lot of people talk about manipulation. Sure, there's manipulation. We know that. But at the end of the day, it's very difficult to manipulate this stuff, right? I mean, you can't just conjure this stuff out of the air and sell it. You can use paper to do that. But there comes a time when paper markets break and people lose confidence in that. And we saw that almost happening just last year, right? I mean, again, premiums were soaring when banks were failing. Why was that the case? I mean, a lot of it was the smart money. I've heard from dealers that from SD Bullion specifically, they were seeing a lot of huge orders coming, $1 million orders coming in, $500,000 orders coming in. And to me, that means that the smart money, maybe they're not accumulating physical, or if they do, they're kind of doing it under the radar to try not to move the price too much. But they know when they start seeing these banks fail that there is ultimately going to be an event where a huge amount of dollars are created to create liquidity in a system where the credit has frozen up. And, we don't know what that event will be, but when it happens, physical is going to be in huge demand. So, breakout and paper price is great. You can look to paper instruments to profit from that perhaps, but ultimately this is going to be the stuff to hold. And I think the companies, the businesses that produce the physical stuff will do well in that event as well, because, they're sitting on large amounts of physical gold and silver that are in the ground. How about this? Here's another reason that ultimately, the deficit spending is going to persist in an enormous fashion. The amount of money being borrowed from tomorrow and spent into today is not going to be diminishing anytime soon. Of course, you had Bank of America warning, Michael Hartnett warning that the U.S. dollar could go into a debt spiral because we've been borrowing $1 trillion every 100 days. He was warning of that, like a week ago or 2 weeks ago. Well, That's not going to stop anytime soon. We continue to launch airstrikes in the Middle East, and now the most recent report, and perhaps an alarming one, which gives you a clue as to what that event could be, which sends everything into chaos, is this from AP. Report claims the Yemen's Houthis have a hypersonic missile, possibly raising stakes in the Red Sea crisis. So this is unconfirmed, but there are claims among the Houthi rebels that they now have a hypersonic missile capable of flying at Mach 8. And, that's kind of a game changer. The technical specifications of these weapons, people are really uncertain of. They don't know where this might be from, perhaps from Iran, perhaps from Russia. They have developed weapons like that. But the Houthis, you got to keep in mind, they continue to launch their strikes against ships in the Red Sea. They don't have any domestic arms manufacturing there of the nature they would need to keep up these attacks the way that they are, right? So they're getting these weapons from somewhere, and it's like, this is doesn't take a genius to look at the geopolitical chessboard and see that the lines are really being drawn here. Heck, we are waging war on multiple fronts against the global South, the BRICS nations, whatever you want to call them, the anti-Western hegemon. You can label them different ways, but the Houthis certainly are part of that crew. And if they've got a hypersonic weapon, they may just be waiting till a time of their choosing to deploy that. They have targeted U.S. naval vessels in the Red Sea over the past several months. So, what happens if something slips through? What happens if you see a major escalation in the Middle East? Well, we're going to get drawn into greater conflicts. It's not just in Ukraine. There's multiple places where the U.S. is really at risk of increasingly getting entangled in these conflicts. And today, the price of crude oil is reflecting these developments. We've got crude up to $81.21. That is up just under 2%, well over 80 bucks now. And that is a trend that is likely to continue. We had those attacks on Russian oil refineries by Ukrainian drones earlier this week, launching 70 kamikaze drones or something like that. Rosneft, one of the big oil giants in Russia, their largest oil refinery, had 3 drone strikes on its condensing tower. I've heard reports now that Russian oil refining capacity is down significantly as they are, dealing with these strikes. I'm sure that it'll come back online eventually, but it just goes to show that nothing is really off the table here. We're seeing day by day escalations, and ultimately, this is going to lead to much higher inflation that the Fed will be completely helpless to fight. You know what I'm talking about? Inflation just in the sense of higher prices for everything. You're going to see the price of crude oil go much higher if, Russia's energy infrastructure continues to come under assault. They're the world's second biggest exporter of crude oil and of petroleum products. You've also got the possibility of Iran getting drawn into this, shutting down the Strait of Hormuz, maybe even direct strikes from the U.S. on Iranian energy infrastructure. You can see how this is going to play out. So the Fed is going to be helpless to fight inflation here moving forward. And the reason is because the problem with inflation, it has nothing to do with the Fed keeping, it has something to do with the Fed keeping rates too low, but ultimately the problem really comes from massive amounts of deficit spending in Washington and an enormous debt bubble that is being inflated. And the only thing that the Fed does by hiking rates in the face of that is they exacerbate the debt problem, right? The interest on the national debt goes up. We're paying more than $1 trillion just in interest now. That number is on the rise. That was last November. That was 4 months ago now, or 5 months ago, that we saw the interest rate on the U.S. national debt cross $1 trillion. That number keeps moving higher. You got to keep that in mind. So you're spending $1 trillion that you don't have every 100 days. You're paying $1 trillion in interest on the national debt. Ultimately, this sort of thing starts to add up, right? And it's another reason why ultimately the Fed is going to have to cut rates to diminish an unsustainable and exponentially growing interest payment on the national debt. And also to the extent that, we see no signs of this deficit spending slowing anytime soon. What was it? Biden just proposed a $7.5 trillion budget or something like that. Absolutely enormous. There's not even any hint of getting back to anything resembling sane fiscal policy at this point. I mean, at this point, I think they're just saying, screw it. Just spend it all, borrow it all, right? Because, uh, I mean, at this point, it's so far gone that if you stop the deficit spending, I mean, it's the only thing holding up the whole House of Cards economy. Everything is going to collapse, the financial system, the consumer, everything. So they've got to keep doing it. But, it's unsustainable, right? It's an exponentially increasing curve, the interest on this debt, the amount of debt being created. So we're heading towards a reckoning. I mean, the modern monetary theorists out there who think that a nation's debt represents its wealth, I mean, they're crazy. First of all, there's no evidence of that historically. And, it's a lot of this mindset, I think, that this time it's different, right? We know better now. Bidenomics has got everything solved. Sorry, I mean, I'm laughing at this, but it's because it's so absurd, right? You shouldn't laugh when your nation's currency is being eviscerated and completely debased. But nonetheless, it is sort of clown world stuff when you hear people saying things like this, that you can just borrow endlessly, and that a government isn't like a household. Yeah, C-130 says no more free stuff. Well, yeah, we've all gotten accustomed to free stuff in one way or another, whether it be the fact that we run these enormous trade deficits, which are enabled by the dollar status as the world reserve currency. Yeah, you got big trader there saying no such thing as free. Well, you're onto the right track there, sir. There ain't no such thing as a free lunch. And some of the most expensive stuff that you ever get is the stuff that the government gives you for free. And also, the massive deficits that we've been running, the exporting of our debt and inflation around the world, it has enabled Americans to live beyond their means for decades. But ultimately, there will be a very high cost for this, in the sense of losing the dollar status as the reserve currency, a soaring rate of inflation domestically. And do me a favor, we got almost 300 people on the chat. We got 81 thumbs up. Smash that like button. Let's get that to 100 if we can before the end of the live stream. And if you haven't subscribed yet, consider subscribing to the channel. But look, I wouldn't be surprised if we see silver in the green tomorrow. If you look at its chart, we're very close to breaking out. We can just zoom in here. I mean, this is a weekly chart, so you can see we're even still in the green, but we're really approaching that top trend line of the handle part of this chart. And when this breaks out, not only is silver going to move in a big way, I think it's going to confirm gold's breakout after a fashion. I mean, gold has already broken out of its chart, its same formation, and really nobody seems to be paying attention to it. I've even gotten comments from viewers, from all of you, who say that you've gone to your local coin shop and people are selling gold. That is not really what you would expect from the public when a market is near its top, right? You would expect people to get into kind of like this frenzy, like with Bitcoin, going to Bitcoin ATMs and paying high fees just to get a couple Satoshis. You're not seeing anything like that with gold. Silver Dragons put that video out that I commented on, where his coin dealer said that he was seeing a bit of an uptick in gold interest, and people were buying gold backs because they couldn't afford an ounce of gold. But mixed reports, it doesn't seem to be the case across the board. And you look at SD Bullion, their premiums are still pretty low on gold. Many of the big online dealers have a pretty low premium on gold too. And you'll know when things really break out, that's going to change, right? Premiums are going to move up in a big way for physical, because you're going to know people are actually buying it. But that doesn't seem to have happened yet. So I think when silver breaks out, that will confirm what is going on with gold. And, the other metals are starting to move a bit too. We had a bit of a big price move in copper. That's going to be good for the miners, of course, because a lot of the miners who are mining gold and silver, they mine copper as well. And the gold and silver is sort of like a byproduct. So, commodities are starting to move. We're starting to see the metals move. That too is going to have a big impact on inflation, but it's not going to matter, right? Inflation is baked into the cake at this point. The Fed's not going to be capable of fighting it. They're going to have to cut. They're going to prioritize keeping air in the bubble over keeping the purchasing power of the dollar intact. I mean, every single thing they've ever done in their history has shown that that is their preference, right? So there's no reason to believe that the Fed is going to allow the financial sector to collapse before cutting rates or returning to easier policy. They're going to do it. And you want to get prepared for that, because when the Fed starts cutting, when silver breaks out, these prices that we have in these safe haven assets today, I think are going to be just a fond memory So let me know what you think about that in the comments down below. I see a lot of people like the video when I asked for that. Thank you so much. I really appreciate all the support. Don't forget to like, comment, and share this with your friends, because I think they'll thank you for it a couple years down the line when we're looking at where gold and silver end up. Anyway, not financial advice, just telling you my thoughts on things. Thanks for watching, everybody. Stay safe and happy stacking, and I'll catch you next time. Smart Silver Stacker out.